Welcome back to SR Money News. Wall Street is currently witnessing a critical breakout watch as semiconductor stocks rebound aggressively. This vital industry holds an unmatched core moat. Think of this moat like a proprietary high-speed toll booth on a digital superhighway. Every byte of artificial intelligence data must pass through this hardware. The physical infrastructure of computing is concentrated among a few select designers. They hold exceptional pricing power and structural dominance. As chip stocks recover from their recent sharp decline, we see the entire index stabilizing. This rebound highlights how dependent modern financial markets have become on Silicon Valley's foundational hardware. The immediate implication is clear. Portfolio managers are treating advanced hardware design as defensive real estate. The forward shift is even more profound. Computing power is transitioning from a cyclical commodity to a permanent global utility. To understand this ecosystem, we must analyze the mega-cap tech giants driving this infrastructure boom. These firms represent the massive operating segments of the digital economy. Think of these hyperscalers as virtual power plants supplying electricity to modern businesses. They capture enormous cash flows from enterprise software, advertising, and cloud architecture. Now, they are redirecting this massive capital into specialized hardware installations. This creates an insulating barrier around their core businesses. Smaller competitors simply cannot match this multi-billion-dollar scale of deployment. As these technology heavyweights prepare to report earnings, market volatility is naturally increasing. Investors are assessing whether these companies can maintain their historically high profitability. The strategic reality is shifting rapidly. These giants are no longer just software platforms. They are transforming into the indispensable gatekeepers of global business infrastructure. Our focus now shifts to the financial mechanics of this cycle. We are tracking a significant capital rotation as mega-cap technology firms expand their capital expenditures. This massive spending directly impacts their near-term free cash flow. Think of this intense capital investment as planting a massive commercial orchard. The upfront cost of purchasing and planting trees is incredibly expensive. However, once those trees mature, they produce highly profitable fruit for decades. Right now, these companies are building the orchards of the future. The immediate financial implication is a temporary compression of free cash flow margins. Yet, this spending guarantees they will own the critical infrastructure of tomorrow. We are moving away from light capital software models. The global economy is entering an era of heavy physical technology building. This transition will permanently redefine corporate balance sheets and asset valuations. As these critical quarterly updates arrive, management commentary will dictate near-term market direction. Executives are under pressure to justify their capital allocation strategies. Think of corporate guidance as a ship captain navigating through thick morning fog. The captain must assure passengers that the ship is on course despite limited immediate visibility. Investors are demanding proof that these immense investments are yielding tangible corporate returns. We expect management to emphasize multi-year customer commitments and enterprise cloud growth. The immediate consequence will be a sharp differentiation between companies showing real utility and those selling pure hype. We are transitioning out of the speculative discovery phase of artificial intelligence. Today, we enter the strict monetization phase where real productivity gains are required to support stock prices. To understand the broader environment, we must analyze the structural industry context of semiconductor fabrication. The chip market is historically cyclical and highly sensitive to supply and demand imbalances. Think of this cycle like the predictable flow of ocean tides. There are periods of extreme high tide when supply is low and prices soar. These are inevitably followed by low tides when excess inventory floods the market. Currently, advanced lithography systems are in high demand, creating a structural supply flaw. This stabilizing factor prevents a deeper downturn across the index. The immediate impact is a resilient pricing environment for high-end silicon. This resilience supports the valuations of both designers and manufacturers. The forward shift suggests that the extreme peaks and valleys of past cycles are smoothing out into a steadier plateau. However, this stabilization is constantly tested by complex geopolitical dynamics. Supply chain concentration remains a primary structural risk for global markets. Think of this concentration like a single narrow bridge carrying all shipping traffic between two giant landmasses. If that bridge experiences any delay, the entire global supply chain grinds to a halt. Because precision manufacturing is geographically concentrated, regulatory and geographic risks are highly elevated. Governments are actively subsidizing domestic manufacturing to diversify this critical risk. The immediate economic cost of this regionalization is significant margin pressure. Building duplicate supply chains is far more expensive than relying on centralized hubs. Consequently, we are transitioning to a multipolar supply chain structure that will alter manufacturing economics for the next decade. This geopolitical friction brings us directly to the core systemic risks facing investors. The premium valuation multiples of these tech leaders leave little room for execution errors. Think of an elevated valuation multiple like an acrobat performing on a high tightrope. The higher the rope, the more spectacular the performance looks, but the more devastating any minor stumble becomes. High interest rates act as a constant downward gravity on these multiple assumptions. If corporate earnings growth slows even slightly, a rapid price correction can occur. The immediate threat is a potential contraction in price-to-earnings ratios across the tech sector. This could drag down the broader index regardless of individual company strength. Investors must prepare for an era where valuation discipline matters far more than growth speculation. Despite these challenges, the long-term outlook remains supported by a powerful structural trend. We are entering the era of sovereign AI, where nations build domestic computing infrastructure. Think of sovereign infrastructure like countries building their own internal national highway systems. They cannot rely on foreign systems for critical transportation, so they fund domestic network construction. Governments are now treating artificial intelligence capability as a vital element of national security. This state-level funding creates a massive, non-cyclical source of revenue for chip designers. The immediate implication is an extended period of forward earnings visibility. This visibility provides a safety cushion during typical market downturns. We are witnessing a historic transformation where public national treasuries, rather than private venture capital, fuel tech growth. As we enter this critical earnings season, strategic asset insulation is paramount for long-term survival. Think of portfolio diversification like putting a reinforced steel frame on a building. It provides structural integrity, allowing the building to withstand heavy storms. By balancing high-growth hardware names with cash-generative software giants, investors can weather near-term volatility. This balanced approach protects capital while maintaining upside exposure. Here at SR Money News, we specialize in providing this level of deep institutional-grade research. We help you cut through market noise to find structural truths. Subscribe to SR Money News today to receive our latest macro analysis and sector deep dives. Thank you for watching, and join us in our next video as we continue tracking the shifting forces of global finance.